I tracked him down. It took me over 24 hours, but I finally found him. So Larry is here with our belated coverage of Cathie's report, which that was late by a week. And then there was this whole thing of hunting for Larry Goldberg. Glad to have you on today, Larry.
Thank you, Randy. And, I apologize for yesterday, but the truth of the matter is I had so much fun. I took my neighbor's son to a rocket launch. He had built a amateur rocket and he participated in a rocket launch. There are a couple hundred people there launching their rockets, and hadn't experienced this amateur rocket business, although I, as a kid, had done amateur rocketry. And we had just so much fun, but it was a lot further and it lasted a lot longer, and it was a lot hotter and a lot more humid than I had anticipated, but we had fun.
Well, at least it was a fun day. That's right.
So I don't apologize at all.
I know you didn't, you never did. No, anyway. All right. Well, what we want to do today, well, Cathie went a little bit, she's been doing these rather unusual methods. She says she's going to continue to do that, which is she's going to start with one of the companies she follows and kind of take them apart piece by piece in terms of the methodology that they use for valuing the company. So I'm going to share my screen. With any luck at all, this will work the first time easily. I got to find the share screen. There we go. I've got it. And then here we go. Maybe this will share screen. If I did it right, probably not. You see, still, it says it's not giving me what I wanted here, but we'll get it. We will. Yes. Now it's loading. Ay. Well, it's okay. I can, why is it taking so long?
Something wrong.
Yeah. Is it loading? All right, let me refresh. See if I can get it to, there we go. And now.
View, click on view.
Yeah, I'm gonna find, there we go, view, slideshow. Okay.
There you
go. All right. So what Cathie does, she says, is that she does, her company does a model, and they use, I believe it's 15, if I remember her saying it right, different points to score the companies to determine what their position is going forward. And it's all based on a 5-year price target. They seek to achieve a maximum hurdle rate or return.
Minimum hurdle rate.
Oh, minimum, you're right, a minimum. Yeah, that makes way more sense. Yeah. Minimum hurdle rate of 15% on average return over 5 years. Then they monitor the CAGRs alongside the other metrics, and that is how they get to their conviction levels. Then they will trim or add exposures based on how the company is doing. So Larry, what I thought I'd do is, we're not going to go through all 15 of these because we would never, you and I would never even get to the to the second part of the show. But I thought I would just kind of bounce through these. They have company, people, and culture. And so there would be like key man departure, which for Elon, he says he's done. He's basically going to be unnecessary as soon as full self-driving is complete and operating at safer than human levels. So is that how you see it?
No, I don't see that at all. I think Optimus is going to have a life of its own. Energy is going to have a life of its own. And AI in general, as far as, real world AI and Tesla is going to have a life of its own. So I think that he's done with the vehicle business. He's solved the vehicle business, just like he solved the Falcon 9 business, the launch business in SpaceX. But as soon as he's solved a business, he's already creating a new one in his mind.
Yeah.
And I think that I think now that this case is over, or is going to be over, and we can talk about that separately. But now that the court case is over, and I think as soon as they resolve his salary going forward, I think he will be inclined to reinvent Tesla again and again and again.
Yeah. So they also mentioned inefficient talent acquisition. Now, these are this is Tesla specific, inefficient talent acquisition. She's just saying they have a high risk turnover, but recognizes they also have the best talent pool. The threat of legal action, which again would take us an hour to just go over that.
Right, right.
Poor governance, she says she certainly doesn't agree with anyone who feels they have poor governance.
Right.
On execution, she says an insufficient / declining level of R&D spending. Thoughts?
Yeah, I mean, we're seeing an explosion of R&D spending at Tesla. There's no doubt about it at all that they're building Optimus, they're building new cars, they're continuing with AI evolution. So I think that in fact, I had a whole discussion about the future of Tesla R&D. And the fact that I think that Tesla really should raise more money because I think the R&D is going to explode.
Yeah, I actually ran a poll on X asking whether people thought that they should raise money or whether they should give money back or buy shares back. And I had such insufficient numbers of people voting that I haven't even bothered to report it. I think people don't have an opinion on it very much.
Well, I will tell you that my post about Tesla wanting to raise Tesla should raise money got a few negative responses, but it got I wouldn't say overwhelming positive response, but it got a good positive response. I mean, the thought was this is not a good environment to raise money because of the cost of money.
Right.
But and there's no doubt they missed the opportunity to do that in the earlier days when money was so inexpensive. They're giving away free money. They were having free money sales.
Right.
And Tesla could have attended at that. And I would have loved them to have done that, but they didn't.
Yeah. So incorrect target operating model. I think, people are arguing that they're not choosing the right product mix. But I think you and I would think that while we might disagree that there hasn't anything, I don't think they've done anything incorrectly. There's probably reasons we don't know for some of their choices. The one that I have the biggest problem with is the Juniper not being put forward faster.
I think that by and large, they haven't been conscious of model refresh and new models as they should have been. I would critique them that I'd give them some slack because of the pandemic and the struggles with supply chain during the pandemic. But I think that they adopted a wait and see attitude with FSD to see if FSD could move along fast enough, and because that would obviously change the whole model, the approach to the model mix. And so if you combine the two events, the pandemic and the FSD expectation, you got a sort of stasis in the model development. So
Yeah.
I would definitely agree that there was a critical delay in model development and model refresh due to these factors. And it's a pity because I think there's no doubt in my mind, none at all, that they could have been much more proactive on both fronts.
Well, of course, I've turned out, a broken clock, Larry, as you pointed out many months ago, is right at least twice a day. And I was right that if we go through this, we're going to be only doing this for this hour. So I'm just going to mention that, first of all, folks might want to just take a snapshot of it and use this for their own analysis of companies. Did you think that their method, Larry, does it meet your seal of approval as someone who's picking growth companies and up and comers and stuff?
Yeah, I think, I would say that it's extraordinarily difficult to reduce this to a formula. Because I'll put it this way, that every truly successful innovation company is successful in a different way.
Uh-huh.
And it's really difficult to find one that fits a pattern.
Mm-hmm.
Really difficult. If you look at the early days of Microsoft, if you look at the early days of Amazon, and you look at the early days of Tesla, and you look at the early days of SpaceX, or any one of the really great companies, you would find an incredibly hard, it would be impossible to find what is in common across them all.
Uh-huh.
And so I think that if you applied this pattern to it, none of those companies would have met the pattern. So I have a completely different approach to real innovation, because I think that at the scale they're looking at, it's really difficult to find true innovation. And I think it reflects in some of their investments.
I see. Okay. Interesting. Well, we should get you and Cathie on together and have that debate.
Yeah.
That'd be
happy to do it.
All right. So then I'm going to stop sharing for a minute because she did a bunch of different conversations without any slides this time. Oh, there goes mine. And so I was wanting to go through a few of those, Larry. And what we have is, if I could get all this to line up, here we go. So one of the things that you talked about at the top was that the Fed has now shifted their emphasis to the employment side. And at the same time, there's been, I don't know, a dozen articles, at least significant articles from significant players talking about how the government numbers, people are finally catching up, that the government numbers are not right, that they're way off, and that in fact we might have negative employment for 2023, for at this point, or the last 12 months, we might be actually looking at negative full-time employment. Whatever.
Yeah, I mean, the employment report is amazing. They said, oh, we expected 190,000, we got 206,000. But when you adjust for another downward revision, like the highly concerned, we've talked about this before, every single employment Friday report is the same. Excuse me, that's a technical term. You see the downward revision making last month or last quarter or last period's appearance of growth a joke.
Yes.
So our downward, we expected 190, we got 206, but with a downward revision of 95, it's actually up 116,000, which is a deficit on expectation of 76,000. That's like 30% deficit.
Yeah. And that was, if you take out the part-time workers and subtract the loss in full-time workers, you're in a, she says the actual household survey was negative. Absolutely.
Yeah, absolutely negative. Yeah. Which is recession.
Right, exactly. Then she talks about the economic indicators, saying that at this point, pretty much everything is headed negative.
Yeah.
It's hard to find an economic indicator that is, about the only thing left is the service industry is still showing some positive growth, but
personal income.
Personal income. Yes, she did mention.
Personal income went up and spending was down. Not up, it wasn't down.
Not down.
Spending was only up 0.2%. Personal income was up 0.5%.
Right.
Which means that people put 0.3% into their pockets. Why?
Right.
Why? Because they don't have confidence in their job and in the economy. And
right.
that spells recession.
Right. And the other thing she talked about in that same vein was, of course, she's been really thinking that the depreciation, or I'm sorry, the disinflation would eventually go into deflation. So she's been a little bit ahead of that curve. she now says, well, the price cuts are starting in the mass market and the fast food area. And Pepsi was actually down 4% on their print. That we're starting to see these price cuts that are happening at these two places, which may result in margin compression. Wondering if it will show up this quarter. It may take a whole another quarter before we see that margin compression.
Yeah, the Pepsi decline, she acknowledged, could be due to Ozempic. I mean, talk about a cultural shift. I mean, I think it's really unfortunate, this whole Ozempic thing. I could definitely benefit from Ozempic. I'm grossly overweight, but I'm really worried about decline in muscle tissue, because that's been reported with Ozempic. Nonetheless, she ascribes half of the 4% decline of Pepsi's numbers, half of it, to Ozempic. That's a stunning calculus. I mean, is it possible that the entire country is taking Ozempic? Well, and reducing their
Pepsi consumption. Well, it would have to show up.
Well, generally sugary food consumption.
Yeah, it would have to show up in Coca-Cola too.
Would it have to show across all of the snack foods, and sugary drinks?
Right. Yeah. So we'll see what happens on that.
And alcohol and alcoholic drinks.
That would be true.
So that would be, that's an interesting play. I mean, sell short this whole food group, the drinks group, and, buy Ozempic,
Right.
I mean.
Yeah. All right, I'm going to share the screen again. With any luck, it'll take less time than last time. Doesn't seem to be taking less time, but we'll see what happens here. I keep on getting this problem of not loading right. Here we go.
Okay.
We're getting better and faster. With practice, who knows? I might be able to do this, Larry. All right. So the first slide she put up was that the
Russell Value Index. This is Russell 1000 Value Index versus Russell 1000 Growth Index,
right,
year over year, and it just shows. I mean, it's amazing actually to show that when value drops and growth goes up, which is what we've been through here in the end of the period, versus when value went up and growth went down, which is that ring period.
Right.
And that's where you move, from this period of bullishness into this period of bearishness. So bullishness over growth versus bearishness. And so that's really what we're looking at here.
So we have huge bullishness now with this down under the mean line. And, and then the question is, if and when does this turn around? And I've been having that conversation with almost everybody on this channel for the last little bit as to, are we going to see any kind of rotation? She seemed to be of the opinion that we will see some rotation as these companies start to become more efficient in the Russell and in the small and medium caps.
Yeah. I mean, we're going to, if we actually move into a recession, and these staples will improve and these growth stocks will go down. And that's why she says there'll be a rotation. But she says in the next 10 to 15 years, real growth could move from 3% range, where we've been for the last 125 since the last great technology revolution. And she says then, she thinks growth could go up to 6%, and you'll see, a reversion to this, growth situation. So, I mean, Cathie's thesis is that we're about to enter this massive innovation period,
right,
with these 5 platforms that she has, that she talks about, and that growth is going to change from, the secular 3% level that we've had since the Great Depression, or since the Second World War, really, and that we're going to move into the 6% growth rate. and it's possible, you know. We talked earlier the conversation between us about the enormous growth of the period of the, you know, before the turn of the century and post the turn of the century until the First World War, this incredible revolution, you know, with Edison and the Wright brothers, and, you know, you talked about your bicycles being the great revolutionary period, but actually the bicycles led directly, absolutely directly, to aircraft. And so, yeah, I mean, we could well see that period renew itself. I will also warn everybody that the Great Depression happened in the middle of all of
Right,
that.
exactly. That's right. So yeah, so Cathie goes back, as does Tony Seba, goes back and says, look, up until 1840, or, you know, whenever we want to start the Industrial Revolution, you were looking at sometimes like most of those millennia, you would have seen zero growth. You basically had
0.2%, I think, is
something like that.
was
Yes.
the secular rate of growth.
Right. And then
So,
the first Industrial Revolution, we saw, you know, a dramatic increase there. Then you have the second Industrial Revolution. Now we're in this information revolution, just about to start into maybe the robotics and AI revolution. And that's where she thinks we go into this 6% growth. And, you know, I don't disagree with her. I think whether it shows up in GDP growth or whether it just shows up in wealth, there may be a new way to have to look at things, because I have this kind of ongoing theory that people are not as interested in stuff anymore, Larry. So if they're not interested in stuff anymore, and it's all about experience, we could see the cost of stuff go down, continue to go down, as it has for the last 2 years, as everybody just changes their buying habits over to experience.
Well, you know, I mean, Cathie talks about the 5 platforms: robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing. I generalize that a little bit more, you know, to the digital revolution, and the digital revolution is really driving all of this, all the knowledge revolution, if you like. And I think it's really driving all of the above. I'm not sure blockchain is as profound in that as the rest, but it could be, for all I know. But anyway, she sees this profound change on these 5 platforms because she has to invest money. And so she turns this revolution that we're in the midst of, you know, we were in this industrial revolution, now we're in this digital revolution, and she turns that into, you know, investable concepts.
Right.
And you know, I see that, and you know, I'm an investor in ARK funds, so I should, you know, I do acknowledge her skills, and I do follow her for them. I think there's a more general thing going on than these specific platforms, but the platforms are a nice way to think about investing.
All right, let's look at the next one. We've got, oops, I went too many here. We've got the US 10-year Treasury yield. We've talked a ton about this as well. We've got the yield having gone up, of course, to the 10-year going up to 5% at one point, now dropping back to around 4.3, I think, right now, maybe 4.3. I think around 4.3. So what did you take away from her thoughts about the 10-year?
Well, you know, if she's right, we will see this situation reverse. I mean, if the growth rates actually do, you know, I mean, if we do get to the growth rates that she's talking about, we could well see, you know, us getting back to those levels that we were at. It's possible. I just don't see us ever getting a 10-year yield. You know, 10-year yields at 2.5%, I think, are reasonable.
Everybody would love it.
And I think that's where we probably get to. Even at very high levels of growth, there's no reason why it shouldn't be.
That would, of course, that would take an inflation rate under the 2% level, probably closer to 1%.
Yeah, but I think we're under the 2% already. I think we're close to the 2% in real terms already.
Okay, all right. She said, then we've got the metals to gold ratio. This is one of her favorite, where she compares the purple line here, which is the metals to gold ratio, not the cost of metals, not the cost of gold, but the ratio between them, which has been dropping. The metals, we'll see that chart in a minute, but the metals are really low and gold is extremely high. Meantime, the US Treasuries are very high, and that's the green line. So this is a surprise. I mean, you can see going back to 1998, we've never seen this kind of a spread.
The question is whether, in fact, the situation has reversed, is reversing, or the process of reverse has already begun. That's the question.
Yeah. So there's a little topping off on treasuries, as we know.
Yeah.
We're following that, but it would have to drop a bit. And then if it drops, does the dollar then drop? And if the dollar drops, then the metals would rise, although the gold might also. Anyway, so it's a lot of things going on there. I think right now, one of the things that's part of this ratio that she really didn't speak to that much is that the gold is extremely, well, it's at all-time highs. And it's at all-time highs for reasons. And so some of those reasons have to do with sovereign funds all over the world bulking up on gold. China and some of the Arab countries bulking up on gold.
Yeah, I mean, everybody who is on the other side of the dollar trade, you know, in the trying to revert to gold or trying to move to gold, would have buying pressure. And, you know, but I think that if the US returns to very high levels of growth, I think that will reverse this situation with a bang. I mean, we've been through these periods before.
Yeah,
70s.
right.
You know, I remember the 70s. I mean, this chart only goes back to 1998, but
Right.
you know, I was, as you were, alive and well in the 70s, and I would love to have seen that, you know, that situation. So really speaking, this chart is only showing a period from 2006 to 2020, 16 years, not a lot of time.
Right.
That this was a, you know, a reliable situation.
Yeah. So then she talked about the commodities, which you and I have talked about before. And this is just a fascinating chart to me, but she is showing that there's a clear evidence that we're coming down from these highs that were in the 2006 to 2013, 14, 15 range. And reverting back to the prices that the commodities were in 1980, which is.
Yeah, this is true. This gives an absolute lie to this thing about, you know, we're sucking the earth dry of all the good stuff. I mean, there's so much good stuff, you know, it could keep mankind in these current style of living for another 100 to 300 years. There's no doubt in my mind.
Yeah.
I mean, I think global warming and all is all serious and it has to be dealt with. But the last thing that's happening is commodities are disappearing. You know, when everybody was shouting and screaming about lithium prices going through the roof, I was lithium's going to go down in price.
Well, you should have bought that one. You should have shorted lithium, Larry.
I kind of did. I bought Tesla.
There you go. That's right. Okay. So then she has the, again, I have to move you and I away from this spot because we are in the way. Let's see here. So we have the U.S. domestic corporate business after-tax profit margins. And she's showing that as shrinking. And that's one of the things she was claiming in another portion of what she talked about, that we may be seeing some margin compression. Maybe it's because the corporations are allowing their staffing to remain too high. That's been my claim. I continue to make this claim. I believe that and I've seen this. I've never worked with large corporations, Larry, so I don't know as much about a 200-man business or a 500-man business or 1,000. Maybe you can help me out. But on all the small businesses that I worked with before, if they've got enough money in the bank, and they got enough inventory and sales haven't completely fallen through the floor, they will hang on to their employees until the cows come home, rather than get ahead of it. Has that been your experience as well?
Yeah, it has been my experience. But again, this chart really indicates that we're out of line with, the last 30 years or 40 years of history. And it's only in the late 60s that we ever reached, this level of after tax margin. Our margins are, historically very, very, very high.
But now what you're saying is that in fact they've gotten even higher, maybe because of the tech side of the business having such large margins. But now they're coming down, and that's partially, well, not partially, probably almost entirely due to the portion of the S&P 500 that is not the Magnificent Seven.
Yeah, I mean, there is some rotation, but also manufacturing is coming back to the United States.
A little bit. Yeah, well, I think she's got something on that, doesn't she?
Yeah, she talks about that for sure.
She does. We'll come to that in a minute, maybe. So the market cap of the largest stocks relative to the 70.
And here you're seeing a little bit of rotation. So right now we've got the Magnificent Six, which is the Magnificent Seven without Tesla,
right?
Who are right now valued, together as almost like 15% of the total stock exchange. So that's why the market cap of the top, stocks are equal to all of the bottom.
Right.
And the question is, are we going to see a rotation in that? I think a lot. I mean, we normally do, and it does revert to the norm. The question is, if we are going to see this revolution that she talks about, well, then maybe it won't revert completely to the historic average. I'd love to see what she shows that in 32 and in 39 and 64, 73 and 2000, every one of these peaks of business that, there was this concentration, and then, it normalized.
Right.
And so we could well see that normalization. Normally that normalization happened, after, so the peak in 32 happened because of the collapse of the stock of the depression and collapse, and people just focused their money or placed all their money into the 15 or 20 companies that they thought would survive.
Right.
And then, at the end of the depression, or at the normalization period, they started investing in a wider range of companies as those companies started becoming more profitable and the returns on the concentrated companies were too small. So these things have kind of a way of balancing themselves, I guess, is what I would say. So I don't know. It's the countervailing forces. There's, the new technologies versus the reversion to the mean. And then there's the macro environment that we're in. So it's got to revert somewhat to the mean, but we could well be in an extended period where it doesn't, particularly with the AI revolution.
Right. Although, so I know you're a big fan of the All In podcast as well. And those guys, I think, are aligned that the NVIDIA craziness might not have, they've even mentioned it again, I think this week, that the NVIDIA, the margins just can't sustain, because with those massive margins, other people are just going to try to find a way to not pay those margins, whether it's making the stuff themselves or whether it's trying to find smaller companies that.
Yeah, but I would remind them and you that that's what people said about Google.
Yeah.
I mean, Google, nobody has yet been able to challenge Google in its core business. I mean, the fact that, pardon?
On search and YouTube.
Yeah, and the truth of the matter is that Google's thrown away an enormous amount of money, an incredible amount of money. That's just frittered away. And they also fritter a heck of a lot of money in wasteful spending in their core businesses. But that business still trucks along as an absolute monopoly. AdSense is a monopoly. I mean, functionally.
Yeah.
And so, so I don't know that this is a generally true statement. I think, monopolists do continue to do very well in our economy and in Europe as well.
Yeah. Yeah. All right. Let's see what the next one shows. We got the Apple's average EV over sales. So.
Yeah, I would say that I think you've skipped quite a. Have we skipped some? I've got to look
I don't
at.
think so.
No,
It's possible I might have realigned them. I might have put them in a different order, Larry.
Yeah. Apple's position in the Magnificent Six or Seven or whatever the number is today is a little bit of a puzzle to me. I mean, yeah, they're producing an enormous amount of cash and they're giving it back to their shareholders. But I think Apple is kind of like Google in a way. They're living off, what Steve did for them, with a little bit of, maybe an earpiece and a watch. Small little incremental improvements. I mean, their great big invention, the eye thing, I think is an absolute bust. I don't see it going anywhere anytime soon. And they didn't even perfect it. They didn't perfect it, and they didn't evolve it. So I see them living off this fat for some years, but maybe like Microsoft, they will find that given the resources they've got, Microsoft stopped inventing things. They just started copying, Apple and so on. So, perhaps they will be able to adapt what others have done in AI and improve it. I mean, I don't think the AI inventors are going to be the ultimate winners here. I think the ultimate winners are going to be industry itself and people's use of AI rather than the progenitors of AI. Because I think it's going to commoditize pretty quickly, just as PCs commoditized. I mean, IBM never made any money out of the PCs. They lost money, actually, and they destroyed their company. Anyway.
Yeah. So the U.S. personal savings rate as a percent of disposable personal income. We were talking about that a minute ago in terms of people starting to their savings rate right now is at historic lows after being at amazingly historic highs.
Yeah, and I would want to really look at their accumulated savings as a percentage of the total household wealth, because this is a savings rate of their personal income. This is not their total savings. So I think savings rate is also a function of personal savings. So they went to an enormous percentage of their income that they saved. I mean, 35% of the income. They accumulated fairly significant balances. Have they whittled those down? Has debt risen? Those are, I think, the important questions to be asked.
Yeah. So Larry, I've been trying to follow that as best I can with the banks, because the banks have a pretty good handle on that. And what they're saying is, yes, they've used up their savings. Yes, they've gotten their regular bank account balances back down to normal. And they've also started their credit average household right now, $7,000 in credit card debt is back to normal. So you're really looking at a normalized situation with regard to the consumer. That's why people are suggesting that the consumer is out of The consumer can no longer prop up the economy. It's going to have to come from someplace else.
Yeah, that's interesting. Let's see what I'm quickly looking at what Fred says, and actually Fred says that household saving is down, but it's at a high level for history. Historically, it was down at the $400 billion. And then it rose in the Great Moderation, in the period of zero interest. It rose to about 800 billion. It rose to a phenomenal 2.8 trillion at the peak of 2020, but it's back down, and it's back down to 800 billion, which is, almost the high point of that Great Moderation period. But it's certainly at the average of that Great Moderation point. So I don't think they've depleted their savings by any manner of means. I would actually, I would probably contest that, because it's certainly double the level it was before 2008, between 2002 and 2008. In fact, if you go from 1992 to 2008, it averaged 400 billion, and it's now at 800 billion. So it's not terrible.
So Larry, you and I talked about the two economies, and somebody was saying the other day that the way to save this economy is probably going to be on the backs of the old folks. It's going to be whether the old folks continue to get on those cruise ships is whether or not the.
But it also turns on the. Let me share this. By the way, this is quite a good share because it's. You've disabled participant screen sharing. You got in there.
I have. Yes, I have to give it back to you, Larry. There we go. There you go.
You want to set it. You want to set it to that for the future. But anyway, here is Fred's numbers. Oh, why is it not?
It's all changed, Larry. Zoom has to change everything so that it confuses me.
You seeing the screen?
Yeah, yes, looks great.
Right. So if you look at the share, right? You're still seeing the share, right?
Yep.
You'll see this is the saving, all along from 1992 to 2008, the great, that's when we had this enormous recession, great the global financial crisis. We emerged of the financial crisis with people with very high percentage of their with a very high savings of $800 billion. It peaked actually in 2012, and that was kind of as the recession wore off, and then it dipped again and stayed at roughly the $800 billion level. It went crazy, during the pandemic, but now it's back, and it's back, 2022. Maybe it's down below that now. Maybe I've been misreading that. So it'd be interesting to see if we could get to 2024.
Yeah, I wonder how come it's.
Well, I guess, I don't know why we don't have anything since 2024.
Yeah, that's odd. Well, maybe we can look at that on Monday night, Larry. You might want to remind yourself.
Yeah.
Maybe take a look at that. So let's see if I can see. I have to reshare now. This is always fun, Larry. This is, I'm sure there must be a better way, Larry. I'm not sure.
Yeah, there probably is.
All right, let's go ahead to the next one. Then we've got, this is the conference board's analysis of the consumer confidence. We can see consumer confidence coming down.
And this is not from Cathie, right? This is something that you created.
Yes, she talked about it, but she didn't provide it. So I have both consumer confidence numbers here. We've got that one and the consumer sentiment. I forget which University of Michigan and which one is I think there's another agency, I forget. But so both of them trending down substantially to very low numbers. And the reason in both cases
And
continues.
the only reason they're higher than 2021 is that was the pandemic. So,
Right.
yeah.
And,
Yeah.
and the reason for their concern is their jobs now. That's come up
Mhm.
with a new concern. They're still concerned about inflation, although they're less concerned about inflation, but they're pegging inflation is continuing at 3%. And people have been arguing this, it's pretty funny, Larry. When I was in high school, in my senior year of high school, I was on the debate team, we were arguing about what the right rate of inflation should be. And if anything over 2% was considered to be a problem, that would be in 1965, 66. And they were arguing about that. And then, of course, what happened to inflation after that? So I think inflation at 3% would be a crazy number. It turns out that the 2% that everybody thinks is the perfect inflation rate was a number that was invented by some guy in New Zealand who just kind of took it out of the air, and everybody's just bought into it. But 3% ongoing, it's that ratchet, it's that constant adding on 3%, 3%, 3%, that's crazy. And if you got 3% inflation, you've got to have 5% interest rates.
Yeah. Yeah. I mean, that, whatever the inflation rate is, you're going to have that 2% real interest rate earnings. So these are numbers which we have invented from experience. We don't know, they're just empirical numbers. We don't know what the real number needs to be for perfect growth. But I would venture that, 3% is not the end of the world, just as 2% is not the end of the world. I think that you certainly do not want deflation.
Right.
You certainly do not want very high levels of, you don't want very high levels of inflation. And so what we've learned from experience is that if you allow inflation to be a little bit, then you can somewhat control that. Now, is the little bit 3% or is the little bit 2%? I'm sure there's scholarly articles on it, and I'm sure that all the scholars are wrong.
And then in addition, of course, you have the wags, including me, saying that the reason we need 2% inflation is to have some hope of ever paying down the debt. And it's a way of taxing the lower classes, since we don't tax them on their income taxes. This is a way to tax the poor.
Well, I don't know about taxing the poor. I think, government transfers to the poor have grown far in excess of 2% inflation, far in excess. The government transfers to the poor in modern times are extreme. And when people look at the disparity between the rich and the poor incomes, you can see the amount of transfers from government to the poor are very, very significant.
Oh, yeah.
They're a significant portion of the deficit.
Yeah. So we have this one now. This was the factory information, Larry. So we have, this is manufacturing construction spending, which is not the same as manufacturing increasing. So this is to your point that we've got manufacturing coming back to the US.
Yeah.
And the spending is going up on buildings and on equipment, et cetera, et cetera. But then we have not seen it convert into manufacturing jobs or into manufacturing revenues.
And there's two reasons for that. The one is there's a turnover in new jobs from old jobs, and so old jobs are still declining, even though new jobs are being created. So that's one reason for it. And the other is that the current manufacturing is incredibly efficient.
Mm-hmm.
And so, in another 5 to 10 years, most employment is going to be replaced by robots. And so, and it's already, a very high percentage has been replaced by robots. So
right.
At a certain point in time, total manufacturing jobs are going to be declined to zero.
Right.
So, notwithstanding the fact that there's this enormous construction, there's not that much hiring, while there's quite a lot of firing going on.
Yeah, and quite frankly, I would expect manufacturing construction to continue to get high, or to at least stay at these new levels or close to these new levels, not necessarily because of the various chip acts and all the rest that were put in place, but rather because of what you just said. As the robots become efficient, there's no reason at a certain point, there's no reason to make it overseas.
Exactly.
I was a US manufacturer and I could make things in the United States because we were efficient and because it was hard to ship what I made at a cost that made it better to go overseas. We had this one. You sent me this one. You kind of like this one. I'll just let you talk about it.
Yeah, so this is the kind of investments that I spoke about in the last slide. This actually speaks directly to what I said. This is semiconductor factories, electric vehicles, and battery plants that are opening in the United States. Now, there's a lot of concentration because the IRA Act, the investment, the EV Investment Act,
in the
CHIPS Act is focused on these chips and on cars. But I think we're going to see a lot of manufacturing return to the United States. And so, but the level of employment at these factories are somewhat measured because of the high levels of automation. These gigantic TSMC factories are not going to employ tens and hundreds of thousands of people.
Right.
Going to employ maybe thousands of people.
Right.
And even in EV factories, car factories by definition are still right now very, very, people intensive. I mean, Tesla hires 100,000 people, but that's going to change. That's going to change, and it's going to reduce. But that's good news because it means that we will no longer manufacture in China if we continue to build up our, our energy resources. I mean, even if you take away labor, China is a more efficient manufacturer than we are because they have less expensive energy. And why do they have less expensive energy? Because they have this strange mixture of coal, nuclear, and solar. And coal and nuclear and solar are eating away coal and oil very, very rapidly. And China is going to become, electrically very inexpensive in the coming couple of years. That's a battle we still have to fight, and it's a very important battle. But that's a lecture for another day.
No, but it's a critical one. It's a very critical one.
Yeah.
I was at a party last night of some fairly sophisticated people, and they were pretty much everybody's talking about the energy deficit that's coming up.
Yep.
And that this is going to be a big challenge, in particular, of course, in the United States.
Well, I can see Tesla's future in energy. Tesla becoming, an energy company beyond solar and beyond batteries. I can see it reinventing, building transformers, reinventing building, peaker plants. Well, batteries are functionally peaker plants today, but reinventing, how we connect these things, because the interconnects and the, and the infrastructure is really a serious deficit. And so, that's an area that Tesla could pursue. We talked about Elon's challenge, the challenge of running Tesla or growing Tesla and challenging Elon to, reinvent something new. There's something to be reinvented.
Oh yeah, there's a whole bunch of stuff, and he's obviously extremely aware of the possibilities and the potentials in that field.
Certainly is, yeah.
Playing around here and there, and we could probably expect some of those things to explode. Larry, that is it for our analysis of Cathie Wood this particular month. I am continuing to believe that we're going to be in negative GDP in the third quarter, maybe even probably in the fourth quarter as well.
Like Tesla, I may be late, but I'm always right.
Yes, well.
But the good thing about projecting a recession is that you're always going to be right, even if you may always be late.
Yes, that's true.
There's always going to be a recession.
Always going to be a recession. And of course, I've said on this channel, Larry, and I think you've even agreed with me that recessions are actually good. It's kind of like going to the doctor and getting a little cut open to get some of the goo out, and then you wrap it back up, slap you out, and get you out the door, and you feel better. So that's how I see recessions. And I think this particular economy right now is probably, as I mentioned a few minutes ago, really, really labor heavy. I think there's probably a lot of people working right now that shouldn't have a job. Elon kind of showed that with Twitter.
Well, he showed that with Tesla. You know,
Yes, I do.
I wrote a long piece about, I don't know if you've read it, but I wrote a very long piece about, you know, some of the unique skills that that Elon has in operating his companies.
Right.
And one of the things he does is, you know, he watches the actual cost of operations very, very carefully.
Right.
And he often will just take a knife and cut it because, you know, he has to keep his ratios,
Right.
you know, going in the right direction, and his operating margins has to keep improving. And so he's very focused on that and does a fantastic job, but not all American companies do that. And not all American companies understand that they have to do that.
Right. Okay, Larry. Well, let's wrap it up for this particular session of the Cathie Wood Report. And we'll be looking forward to seeing you tomorrow night on Good News Monday. Any prediction on what Tesla stock does tomorrow with this unusual political weekend we just had?
You know, I don't give a.
You don't care. You just don't
I
care.
don't care. But I did spend the day reading all the arguments in the court, in the case, in the.
Oh, you did?
Yeah. And I have some observations. I'm probably going to write it up tomorrow.
Wow.
So, you know, we could talk about that. That's one area. But you know what? I'm sure tomorrow will bring a lot of trading activity and stock. He has a prediction you can write down.
I know.
It'll either go up or down or stay the same. One of the three.
Okay, Larry, with that brilliance to conclude our show, it's to all of you out there, if that wasn't good enough for you, I don't know what we can do. It's been great talking to you.